Making Tax Digital has everyone asking the same question. Should I move from being a sole trader into having my own limited company? So what we're going to look at today is the taxes that are going to be involved with having your own limited company. We're going to have a look at the thresholds, and then you can see if it's something that you might want to do or if it's not going to be the right move for you. Previously, we were recording all of our self-employment income on our self-assessment tax return. That is going to change because now we have a limited company. So that limited company is going to be filing its own tax return. It's going to be a corporation tax return, and that's going to have to be filed every year. You're going to have to tag accounts to go with the corporation tax return. That process has to be done by an accountant. So there is a higher cost involved with having a limited company from an accounting perspective. Let's have a look at the taxes that your limited company is going to have to pay. And these are the taxes before you're taking out any income from that company. So that's just the income that's coming into the company. So let's have a look. We pay corporation tax on our total taxable profits. Our total taxable profits are different from our accounting profits. So we adjust our accounting profit to get to our total taxable profit. If you want more details on the common adjustments, let me know. Happy to go through it in a different video. So the amount of corporation tax that you pay depends on your profit levels. So if you have a small business and your profit levels, so your total taxable profits are under £50,000, then you're going to pay 19% corporation tax. If your profits are between £50,000 and £250,000, then you're going to pay a marginal rate between 19 and 25%. And if your profits are over £250,000, then you're going to be paying at the main corporation tax rate of 25%. Now, I'm assuming that you're nowhere near this section. I'm assuming we're kind of up in this section here, because I think if you were at kind of profits over £250,000, you'd have already incorporated your company a long time ago. So this video is more aimed at people who are around this kind of profit area and they're just trying to decipher if it's the right move for them. So there is actually a way to extract funds from your limited company that will give you the most tax efficient result. Always chat to your accountant, of course, before you decide to start tax structuring yourself. Please don't do that. Usually what happens is we take a small salary and then we take the rest as dividend. Usually the salary is under the personal allowance, so that's £12,570. Your accountant will tell you what the best salary for you is, given your circumstances. It might be the £12,570, it might be zero. We have to look at your circumstances as a whole to tell you exactly what the best salary is for you. Salary is actually deductible for corporation tax. So your total taxable profits will already have your salary deducted from it. Dividend is the main way we extract funds. Now, dividends cannot be deducted from your total taxable profits. So essentially, you're paying tax twice. So the funds will be taxed at whatever rate you're at, and then they're going to be taxed on you personally again. But before we move on to them dividend rates, I want to also highlight something that I think is a key consideration people are missing here. So when we have a limited company, you choose how much of the income of that business that you're drawing out personally. So I might choose to not take anything out of my limited company, and it will obviously still be taxed at whatever tax rate I'm at. So say I'm under £50,000, I've got tax of 19%. I might choose to not extract any income from that business. In that case, I won't have any dividends being taxed on me personally or any salary being taxed on me personally. However, when we're a sole trader and we're self-employed, we will be taxed on everything that we earn personally. So, of course, there's no corporation tax, but we are going to be taxed on all the income that we receive. And that's important because when our business starts expanding, we start making lots of profits. There's a lot more tax planning opportunities that can come up because of having a limited company. There's certain structuring and things you can do in order to be as tax efficient as possible. Now, that's a different video, and I assume we're kind of not at that stage yet, but if anyone wants any more information, I'm of course happy to go through it. So let's have a look at them dividend rates. So dividends are taxed at a lower rate to income. So our self-employed income that will have previously been taxed on us at 20, 40 or 45% dividend rates are lower than that. First up, we're going to have a £500 of dividend, which is going to be tax-free every year. So you want to get your £500 out, even if you take nothing else, because it's tax-free, which is great. Then we have our basic rate band. £12,570 is our tax-free personal allowance. Everybody gets that every year. When our income exceeds £100,000, then we start to lose our personal allowance. And when our income exceeds £125,140, we totally lose our personal allowance. So between the £100,000 and £125,140, our personal allowance reduces. Basic rate band, £12,571 to £50,270, 8.75% tax. So that is very low. Compared to previously, we'll have been paying 20%. But remember, you have already been taxed in your limited company and paid corporation tax on these dividends that you're now going to be taxed on again. Higher rate, £50,271 to £125,140, and that is going to be taxed at 33.75%. Again, remembering about that issue with the personal allowance going over £100,000. Also, once you go over that £100,000, that will likely mean that £12,570 is no longer the best director salary for you. I have a whole video on director salaries if you want a little bit more information on that. But again, we want to talk to our accountants about stuff like that. Additional rate, so that's anything over £125,140, and that is 39.35%. However, we've already paid that corporation tax, and I think that is the point people are missing here a lot of the time. So really, what you need to do is, your accountant can do this for you. We all have the software to do this. It takes about 30 seconds. They can run your profit from last year, tax it to corporation tax rates, and then put it through in the most tax efficient way, as if you had a limited company, on your tax return, and they will tell you how much tax you're going to pay. Now, you still, if you have a limited company, you're filing your corporation tax return for your limited company, you still have to file a self-assessment tax return to declare to HMRC what your dividends have been for the year, because these aren't taxed immediately when you extract the funds from your limited company, so they have to be taxed at the end of the year. So you're still going to be filing a self-assessment tax return, and you're still going to be paying your accountant to file that self-assessment tax return. So for example, if your business makes £30,000 a year, then is all this hassle worth it? Probably not. You're probably better just to carry on being self-employed as a sole trader, remembering you're not even going to be in Making Tax Digital for the first year because that is profits over £50,000, but remembering it is self-employment income, it is foreign property income, and it is UK property income. If your combined income from all of them exceeds £50,000, you're in. So it's just being mindful of that and thinking, I'm going to have a lot more costs if I set up a limited company. Am I looking to expand my business and do big, wonderful things? Or do I just want to continue the way I've been going, and I accept that my accountancy fees are going to go up because of these 4 reporting returns? Because they are going to increase. There's no two ways about it. And if you can do it yourself, great, then carry on.